You have said that Fed policy, Jay Powell was the primary culprit, the pace really of rate hikes from such a low base. But for you, is the risk of a systemic credit event still key? Has that been avoided?
Well, I think they're addressing the liquidity issue, but not really the solvency issue from our point of view. A couple of things have happened here that have never happened really in history, and so the banks didn't expect it. The first was interest rates up 19-fold in less than a year. Never happened. Under Volcker, which it was twofold, 10 to 20%. And the low base does matter. Many people dismissed it, saying, oh, just such a low base. No, expectations were low base. So that was the first. We've never seen that magnitude of an earthquake, I would say. Then the second thing that no one expected, again, because it hasn't happened in such a long time, was deposits leaving the system. For Silicon Valley Bank, it was venture capital facing a funding drought, and so they had to draw down their deposits. But then for others, you've got money market funds paying much higher than deposits, attracting flows. So that combination was lethal. And so now they have the backstop in. Now what do we have? We have they're going to be paying up if they're depending on the facility. They'll pay roughly 4.37% right now is that rate, OIS plus 10. And that's much higher than many of them have been paying for deposits, number one, while in the case of Silicon Valley Bank, their average held to maturity security on the asset side of their balance sheet was only 1.6. So they're going to see net interest losses. Now, instead of having mark-to-market hit equity, these losses are going to hit earnings.
Cathie, that's the cause. Let's go to the effect. Since the collapse of Silicon Valley Bank, the market has changed its Fed expectations for a less hawkish or a more dovish Fed. You cite the Fed as the cause. How nimble are ARC being? How much are you recalculating your view going forward?
Well, as we said before COVID, as we were descending into that, and we are saying now, innovation solves problems. And you showed a few charts at the beginning that suggest that some of the innovators out there are solving problems. I mean, I think the most dramatic example of it to us was the behavior of Bitcoin last week. It absolutely took off. It was a flight to safety vehicle. And so it is really proof of concept that innovation solves problems. There are, in Bitcoin, fully decentralized, fully transparent, auditable, which is addressing all of the banking's problems right now. And so a flight to safety, a little bit of an insurance policy. There's no central point of failure in Bitcoin.
Caroline, ARC has 2030 calls on Bitcoin, the most bullish case around 1.5 million on Bitcoin, the most bearish around 250,000 on Bitcoin. Somewhere in the middle, you have around 682,200. That is the sort of base case there. Interesting at a time when no one is making that kind of long-term projection.
Yeah, and Cathie, we know you're a long-term investor with long-term calls. But what on earth gets us to that bull case of almost $1.5 million per Bitcoin if a bank crisis doesn't? One of the things that happens in a crisis is liquidity dries up. So that tends to hurt assets. And the fact that Bitcoin moved in a very different way from the equity markets in particular was quite instructive. You'll find the building blocks of those price targets in our Big Ideas 2023. So ARC Big Ideas 2023, and they are, for the base case, I would suggest quite conservative. We've dialed some of them down since last year. I know that corporate treasuries pulled away from Bitcoin because the regulators were pulling them away from Bitcoin on their balance sheet. So we've pulled back there. But we do believe that the behavior of the price through this crisis is going to attract more institutions, for example. We've done a report targeting institutional investors and the allocation that they should make if they care about this new asset class diversifying their portfolios. And I believe it's somewhere between 2.5% and 6.5%. So not crazy. These are the sorts of allocations they would have made to emerging new categories of assets like real estate in the 70s, emerging markets and small cap in the 80s and 90s.
And Cathie, I mean, Ed, let's discuss some of the ways that Cathie and ARK have invested and got exposure to crypto. Of course, there's the companies such as Coinbase, but there's also GBTC, the Grayscale, Bitcoin Trust, and regulation is in the eye of the storm there as well, Ed. I mean, talk us through what the SEC seems to be pushing us towards.
Yeah, and Cathie made an interesting point there, right, about institutional investors. Cathie, if I remember correctly, back in 2021, a big part of your thesis on the run-up in Bitcoin was that more US corporates would add it to their balance sheet in place of cash. That doesn't appear to have happened to the level that you'd hoped. Is that because the US is just not a regulatory-friendly environment for this to happen?
Yes, in the beginning of the crisis, it seemed like regulators wanted to blame crypto instead of the significant rise in interest rates and the deposit outflows. Now we're seeing it as a solution to the problem, but the regulators are still reticent. Something interesting happened today, or maybe it was yesterday. Governor DeSantis basically said that he was going to allow, I don't know if he said this exactly, but the conclusion of his saying we're going to set Florida apart from the rest of the nation was this ability to touch companies that touch crypto. After all, these are cash deposits. They're fiat deposits. They're not crypto. And this can be done on a state-by-state basis. So I think you'll see Florida, like it has done in many other ways, distinguish itself from the rest of the pack.
Cathie, Katie Greifeld, my good friend and a just terrific reporter on the ETF Beats, has been talking about Grayscale and the opening arguments in the case with the SEC. In that discussion, how much are you considering adding to your position around trust? How are you reading how that Grayscale situation's playing out?
So it seems as though the judge is having some trouble understanding how the SEC could approve a Bitcoin futures ETF, which is swaps-based and therefore has counterparty risk, but will not allow a spot Bitcoin ETF. It really makes no sense. So they'll either have to basically shut down the Bitcoin futures ETF, it seems to me, or allow a Bitcoin ETF. So I think Grayscale is doing Bitcoin a great service, and its arguments have been very sound.
We asked our audience, Cathie, what they make of the behavior in Bitcoin. This was what they had to say in terms of how the asset class behaves. Is it a must-have in a banking crisis? Few respondents said yes. No, it's too volatile was the main response. Caroline, interested in your take on that. What this all comes down to is how we're playing the interest rate environment, right? How we're reading the Fed, how we're reading across different asset classes.
Yeah, and to that point, Cathie, you have said just earlier in the conversation, the rate of change of the Fed, the 19-fold increase in interest rates that have so upended, you say, in many ways, what's happening in the financial markets and financial conditions. But we did see signaling from the Fed. They did tell us they were going to be hiking rates and hiking rate fast. Why then didn't you move your portfolio around more?
Well, the premise of the question is that we're an asset allocator. We are not. We invest
exclusively in disruptive innovation, nothing else. What we did do was we concentrated our flagship strategy, so ARKK, and our other strategies, ARKQ, ARKW, ARKF, and we moved, in the flagship's case, from 58 names in February of 21, when we peaked, down to 27, 28 names. We have a scoring system, and the scoring system is based on variables we believe are very important to innovation. And so we concentrated the portfolio. Many people in the traditional asset management world, when they go through a risk-off period, they will diversify their portfolios by moving closer to their benchmarks. What they're doing is typically selling our kinds of names.
Yeah.
And so that is why they're putting extreme pressure on them. We'll create losses by selling stocks, and that gives us a tax loss asset, which we have. It's over $2 billion right now, against which we can take future gains, and then concentrate towards our highest conviction names. We have a paper on our site which shows the benefits of this concentration strategy during risk off and diversification strategy during risk on.
But of course, when it's risk off, you've underperformed, and actually even on a 5-year basis. I know people will say, look, you're already looking in a long period, 5-year outlook kind of perspective, but look back from here over the last 5 years, and yes, it's been a turbulent time, it's been an interest rate hike time, but you've underperformed the S&P 500. What do you say to those that have a shorter time frame in terms of investing, those that are looking to retire in the next 5 to 10 years? Should they be with you, or do we have to be long-term equity investors that have a much longer runway to have exposure to ARK investments?
So we're the closest thing to a venture strategy to a venture capital fund in the public equity markets. And a venture fund has a long-term investment horizon. If an investor cannot have that long-term an investment horizon, then they should allocate perhaps a small amount to our strategy, say 1 or 2%, which, by the way, from what we can tell, most advisors have us at that 1 to 3% range. Now, why would you put any if the risk was the volatility that you see on this chart? It is because our companies are going to disrupt the traditional world order. And if we're right, then the large cap benchmarks and even some of the mid cap funds are going to be disrupted. We will be a hedge. Now, I will submit to you that last year was the most unusual year of my investment career. And not only mine, but bond investors. So bond investors had the worst year in 200 and some odd years. When interest rates go up 19-fold in less than a year, it's going to kill long-duration assets. Bonds are long-duration assets. They've never seen a year like that. ARK is a long-duration asset. But if we're right, and these companies are going to disrupt the traditional world order, then we want to be on the right side of change, and the market will come our way, away from those benchmarks, which represent the traditional world order, to our strategies.
For our global TV and radio audience, we're speaking with Cathie Wood, CEO of ARK Investment Management. Cathie, in June on stage at Up Summit, you cited retail inventory levels, and you told me, if you remember, that inflation would unravel. Did you get that one wrong?
No, if you look at upstream what's going on, commodity prices are coming down quite dramatically, some by 70, 80%. And I would also say the retail call was very right. I think you'll agree on that. The discounting, we think, is going to continue to work its way through the system from the commodity price level to downstream near the consumer. And you can see this Tesla is cutting prices. Many people say, oh, it's because of competition. No, it's because their commodity prices are coming down. And Elon's even talking about deflation. And the cost associated with innovation is coming down because it follows a learning curve. So I think the innovation that our companies are delivering are going to be one part of the deflation. Commodity prices another. And I will also tell you, the yield curve, the week before last was down, inverted by as much more than 100 basis points. That also is a deflationary signal, as is what's now going on in the banking system.
Yes.
I think the banking system is fearing deflation.
Well, Cathie, to that note, we've been talking about sort of a de facto tightening of financial conditions in the wake of Silicon Valley Bank. You moved last year to give investors exposure to venture funds, private firms, in that partnership with Titan. Has that proved to be bad timing? How impacted has that been from SVB? And we've only got a couple of minutes left.
Sure. Well, we're fledgling still. It takes a long time. We have, as you say, with Titan, a social distribution strategy. We have other wrappers as well. I much prefer to start a strategy during tough times. And actually now we can be a solution. If we get inflows, people looking for venture, they can get into our venture fund for only $500. So again, the democratization of investing and this idea public closest to a venture capital fund in the public markets to be able to actually do a venture fund at a time that the venture community needs us. If you look at Silicon Valley Bank, that situation has robbed a lot of venture capitalists of funding.
Has it robbed the US of innovation, Cathie, do you think?
I would say that regulations threaten to do that, and certainly in the crypto space, absolutely. But I also think the seizing up is not just a U.S. phenomenon. It looks like it's more of a global phenomenon, judging what has just happened in Europe. So it's not as much that, it is regulation, the likes of which we're seeing around blockchain technology that threaten U.S.'s position in innovation.
Cathie, very quickly, did you have any exposure to SVB?
None whatsoever. I'll say, as our business, no, and our companies, very limited exposure. I was so surprised and delighted to see how little.
Although Roku
I just wanted to clarify that for our audience, Cathie. I'm sorry to jump in, but we got to go. Cathie Wood, CEO of ARK Invest, we're really grateful for your time here across Bloomberg Television and Radio. Thank you.